December 9th, 2025. A day when global markets pause, glance at the horizon, and rediscover their oldest refuge, gold. Gold has always been more than a material asset. It's a psychological anchor, something humanity turns to when trust in institutions, currencies, and political stability falters. As 2025 reaches its final stretch, this ancient instinct resurfaces with renewed force. In today's world, uncertainty is not an exception. It's the baseline. Geopolitical tension, fragmented economic recovery, and conflicting policy responses between the US and the EU have created a uniquely volatile environment. Inflation has cooled, but not in a straight line. Growth is present, yet fragile. Markets are optimistic, yet cautious. Gold thrives in this delicate balance between hope and fear. For individual investors and institutions alike, gold represents a rare constant, a store of value untouched by the decisions of central bankers or corporate earnings cycles. In 2025, this renewed interest has triggered a noticeable shift. Asset managers across the US and EU quietly increase their gold allocations, anticipating turbulence ahead. And so, December 9 approaches with heightened anticipation. Investors wonder whether the metal will break out once more, or consolidate before a defining move in early 2026. Gold's price action has compressed into a tight formation, signaling an imminent decision point. Traders call it the calm before the surge. Behind the scenes, macro fundamentals, investor flows, and global psychology intertwine. Understanding this moment requires understanding all three. And so begins the Gold Playbook, December 2025 edition. The global macro environment of late 2025 is a complex puzzle. Inflation cycles, policy messaging, supply shocks, and shifting capital flows form an ecosystem unlike any seen since the early 1980s. The Federal Reserve paused earlier this quarter, not as a pivot but as a strategic hold. Markets misread it at first, expecting a dovish turn. But Powell clarified, patience, not easing, is the message. Inflation prints throughout the year were volatile. 2 soft months, 1 hot month, another soft month. The inconsistency pushes investors to hedge inflation risk rather than bet on its disappearance. Meanwhile, in Europe, growth remains uneven. Germany wrestles with industrial weakness. France and Spain face persistent services inflation, and wage pressures distort policy direction. Divergence in policy, US holding firm, EU waiting for clarity, creates tension across currency markets. And gold once again absorbs the stress. Oil prices, after earlier year supply shocks, keep energy inflation elevated. The ripple effect touches every asset class, including gold. Currency volatility intensifies. The euro weakens against the dollar, making gold more attractive for European investors. Across Asia, central banks continue sizable gold purchases. China, India, and Singapore are among the biggest accumulators, reshaping long-term demand patterns. Physical demand also accelerates. Jewelers in India and China experience one of the strongest Q4 buying seasons in recent memory. And by December 9, global forces converge. Inflation risk, policy divergence, currency volatility, and central bank accumulation, all amplifying gold's trajectory. Technical charts reveal a market approaching a critical inflection. The trend is intact, but consolidation tightens like a coiled spring. Momentum indicators, particularly weekly MACD, continue pointing upward, reflecting long-term strength despite short-term noise. However, gold sits near near-term overbought zones. A temporary pullback would be logical, but not guaranteed. Volume tells a clear story. Strong accumulation during dips, lighter volume during rallies, a bullish sign. Seasonality remains supportive. December has historically been one of gold's strongest months. Resistance looms near previous all-time highs. A breakout here could spark a multi-month rally. Support zones cluster around long-term consolidation bases. Buyers appear reliably at these levels. The outcome of this compression will define early 2026 market sentiment, bullish continuation, or prolonged sideways drift. Treasury yields remain a critical inverse driver. Each yield spike pushes gold down, and each drop gives the metal fresh fuel. By December 9, all signs point toward imminent volatility, a market ready to move. Gold is not merely a macro asset, it is a psychological asset. It taps directly into human emotion, fear, security, and certainty. Fear of recession drives safe haven flows. Even whispers of economic slowdown can ignite a surge in gold buying. Inflation anxiety adds fuel. Even if CPI cools, the memory of rapid price increases lingers, and gold becomes a hedge against the unknown. Geopolitical tension amplifies it further. Military risks, political instability, and diplomatic standoffs push investors towards safety. Yet gold is not driven only by fear. It is driven by the desire for stability, an anchor in a sea of volatility. Hedge funds position early. Retail investors follow later, often after the breakout. Social media magnifies market noise, creating viral FOMO and waves of panic within hours. December is notorious for emotional trading. Each move feels bigger than it is. This emotional weight makes gold's late-year path especially dramatic, amplifying reactions on both sides. A snowfall of market noise surrounds December trading. Amid it all, gold remains a symbol of clarity. As December 2025 closes, investors shift their gaze forward. The question becomes more strategic. What shape will 2026 take for gold, steady resilience, or structural breakout? Three major forces will dominate gold's performance next year: monetary policy, global economic momentum, and institutional accumulation. Together, they form the backbone of gold's trajectory. First and most influential, the Federal Reserve. Their early 2026 stance will determine the behavior of yields, risk assets, and investor psychology. The market anticipates the first rate cut, but timing remains uncertain. If inflation rises again, the Fed could delay, reinforcing gold's appeal as a hedge. Second, the global economy. Growth may slow subtly rather than collapse, but even mild deceleration increases gold's defensive demand. Third, central banks. In 2025, they bought more gold than any year on record, and that pace shows no sign of stopping. The combination of steady demand and constrained supply creates upward pressure. Gold mining output hasn't kept pace with rising appetite. These factors create a structural bullish environment, not necessarily explosive, but deeply resilient. Investors who value long-term stability see gold as an insurance policy, not a trade, an anchor. And as the world moves toward 2026, stability becomes the most valuable commodity of all. Geopolitics remains one of the biggest hidden drivers of gold. For every headline that captures attention, 10 silent forces ripple beneath the surface. In 2025, tensions across Eastern Europe, the Middle East, and Asia fluctuated unpredictably. Investors responded with caution. Even when conflicts don't escalate, uncertainty alone drives safe haven flows. Markets dislike ambiguity more than bad news. Diplomatic standoffs, trade disputes, and cyber threats contribute to an atmosphere of strategic vulnerability. Gold thrives in environments where trust is fragile, and trust in 2025, globally, is still rebuilding. Emerging markets, anticipating currency volatility, increase gold reserves to shield themselves from external shocks. Even advanced economies diversify. Gold becomes part of national financial resilience strategies. This institutional demand is different from speculative demand, slow, steady, and relentless. By December 9, 2025, it becomes clear. Gold is no longer just reacting to geopolitics. It is anticipating it. In an age defined by uncertainty, gold transforms from a passive asset into an active global signal. Market structure matters. It tells the real story behind price movement, and gold's structure in late 2025 is unusually tight. Large players accumulate during low volatility phases. These periods often precede big directional moves. Futures positioning shows reduced speculative leverage, healthy for long-term stability. ETF flows, however, begin shifting upward. Retail and institutional investors return after months of hesitation. At the same time, physical demand remains robust. Jewelry, coins, bars, everything sells more strongly heading into year-end. Mining supply stays constrained, pushing the supply-demand balance tighter. The market doesn't yet show signs of mania. Instead, it shows signs of structured accumulation, a quiet but powerful signal. When accumulation persists through uncertainty, the result is usually a sustained upward trend. Traders recognize these conditions. Fundamentals provide fuel, psychology adds momentum, and structure provides stability. By December 9, all three align perfectly, a rare triad in global markets. Beyond charts and forecasts lies something deeper: human behavior. Gold is uniquely tied to emotion, culture, and identity. For many cultures, gold is not an investment. It is security, tradition, and legacy. This cultural demand adds stability, even when markets fluctuate wildly. Gold also symbolizes independence from governments and currencies. It's a hedge against mismanagement and political risk. In a digital world, gold represents something tangible and permanent. Even new generations rediscover gold through ETFs, digital gold, and tokenized assets. And this blend of old and new demand ensures that gold remains relevant, decade after decade. By December 2025, gold's role is no longer questioned. It is reaffirmed. Traders watch fundamentals. Investors watch flows. But the world watches gold for what it always represents: trust. And on December 9, 2025, trust becomes the most valuable commodity. Gold faces a paradox: prices rising, yet investors hesitate, afraid they're too late. But history shows hesitation is usually more expensive than action. In the last 5 major gold cycles, late buyers still profited, just less. Yet today's fundamentals make this cycle unlike the others. Because global debt isn't just high, it's compounding faster than growth. Each year the system relies more on cheap money, but cheap money is gone. So gold becomes a valve, releasing pressure when trust erodes. And on this December 9th, 2025, that pressure is visibly rising. From Asia to Europe, central banks are signaling discomfort. The ECB's tone has shifted, quiet but unmistakably defensive. They're worried inflation isn't truly dead, just hiding. Energy markets remain unstable, especially as winter demand surges. And in the US, the Fed is trapped between recession and credibility. A single misstep, and markets will punish instantly. Bond markets already sense it. Yields swing violently on every whisper. When bonds tremble, gold listens. And right now, gold hears danger. Liquidity is thinning, markets move faster, reactions amplify. In thin markets, gold thrives. Its scarcity becomes its power. Meanwhile, mining supply struggles to keep pace. Higher costs, lower grade ore, tight regulations. Even if demand freezes, supply won't magically increase. That's why gold's long-term floor keeps rising. And when floors rise faster than ceilings, breakouts happen. Central banks are reinforcing this trend with aggressive accumulation. They're not traders, they're long-term strategists. And they aren't buying for price, but for survival. When nations prepare for instability, individuals should pay attention. Gold is not a trade, gold is insurance. Insurance against policy mistakes, debt explosions, and geopolitical shocks. Anyone waiting for the perfect price misunderstands its purpose. Gold is rarely cheap. It's simply cheaper today than it might be tomorrow. And on December 9th, 2025, the world is priced for optimism, not reality. Realities like debt, war, supply constraints, and monetary stress. That's why gold's move today is not random, it's structural, driven by the architecture of a world shifting to uncertainty. Investors who recognize structural change adapt early. They position before the headlines, not after.